Writing an angel check is easy. Knowing why is the flex. Angel investing. Underused, misunderstood, explained badly. Angels Decoded. An educated and raw take. In cahoots with Play Money.
Hello and welcome back to episode number 2 of Angels Decoded. I've got my cohort, my cahoota. I'm not sure if that's a word, but my friend and ally. Okay, we're in cahoots. There's no cahoots. Cheryl, Kellond, welcome back to episode number 2.
Thanks for having me back. I thought I was maybe going to get fired after the first one.
Well, I'm not sure that anyone thought that they would invite us back to do number 2.
We actually don't know they have. No one could be listening.
No, we're going rogue right now, and we're going to continue anyway. But that's important. And the reason we're doing this is that angel investment is getting stronger, but there's still a huge way to go in the formalization of the category, who people are that actually do it, how they find founders, and there's a lot that goes behind the scenes. But the topic we want to start on today is around portfolio construction. As an angel investor, having one investment has a really low chance of success, and not based upon your decision or the founder or the business, but there's a numbers game that you have to play. Can you tell us just at the start and a little bit of insight as far as when you're putting an angel bet down, how far do you have to go to think about that collective growth on a portfolio?
Yep. No, let's take a step back on this one, because this one was one of the most, everyone knows my story a little bit. When I started angel investing, I never thought I was going to write checks, right? I was a multi-time founder. I mentor startup founders all the time. And I was like, I'm going to learn about angel investing so I can be a better founder, because I think like an investor, and so I can be a better mentor to the founders I'm working with. And absolutely didn't think I was writing checks. And the breakthrough moment for me is when I learned about the math behind portfolio construction. So everything they taught me in Angel 101 when I was learning was, what's a safe, what's an SPV, what's MRR. And like all of that stuff is super valuable learning, particularly if you don't grow up in tech, if you haven't been around startups all the time, you've got like a fancy job and, real like big girl fintech or at a Fortune 500 company or, operating a real world, physical world business. All of that terminology about angel investing can be overwhelming. There are more resources on that now. And with AI, it got easier to learn that stuff to get you beyond that. But the real information that I found was the unlock for me was all the stuff they didn't tell me. And the biggest piece was about portfolio construction. And I'm a data geek. And so maybe I looked places other people weren't looking. But I dug into all the data science research that AngelList had done. And they've got this very smart chief data scientist there. His name is Othman. Like, so smart, like when you talk to him, you're like, oh my God, I feel like an idiot. I'm embarrassed to even ask my questions. Kind of smart. So I totally fangirl. If you fangirl the data scientist, it's me fangirling Othman. He barely exists on the internet. He does secret projects all the time. He's sort of stealth data scientist. And what Abe did was he looked at all the investing outcomes from early stage startups on AngelList. And they've pretty much got an index fund of the entire, tens of thousands of companies. And he modeled that data every way possible, ran Monte Carlo simulations till his computer started to smoke. And what he found out was there was the only factor that was predictive of the returns outcome of a startup investment portfolio was the number of checks, the number of startups in that portfolio, the number of checks you wrote. He looked at founder experience. He looked at region of the company. He looked at fancy VCs that backed them. He looked at industry. He looked at time. He looked at every possible factor. And the only thing that mattered for returns was how many bets you made. And that to me, that was this giant wake up moment, like, holy shit. I don't have to worry that I don't know enough. I don't have to worry that I need to learn more. I don't have to worry almost that I'm going to make a mistake when I'm learning. If I am in a clean, well-lit space looking for startups, so not going door to door around my cul-de-sac to see which retired guy is making a new hot sauce, but in a clean, well-lit space where professional investors that do this for a living play. If I'm in that space, I can't make a mistake as long as over time I build a portfolio with enough bets in it. So that was this giant aha moment for me. And then I had a duh moment. I was like, duh, it's a freaking index fund. We know that from public markets, right? Barely any managers can outperform the regular index fund in public markets. I was like, okay, so relearned the lesson I learned somewhere else. But it was really liberating for me. Now, on the flip of that, there's good and bad news. First, that number is not what a diversified portfolio means, is not a huge number. You don't have to index every startup in the ecosystem. The AngelList Access Fund actually does that pretty well. They've got a giant index fund that you can buy into that indexes all the companies on AngelList. And it's a top 5% performing fund. Like, not only does the math say this is true, the actual fund they run says it's true. And the problem is it's a wait list to get into that fund. And it's like, a $250,000 minimum bet. It's got its problem. So you don't have to index the whole market. The magic number you have to hit is about 30. And between 30 and 50, like, it's so interesting. You see this curve of like expected returns, and above 30 investments, it starts to get really predictable. Like, you trip over that point of, I'm making one startup investment. It's like a lottery ticket to, oh, I'm building an asset class. I get it. And you can see it really clearly in the data and the numbers. And that was the breakthrough moment for me. Obviously, good news, I didn't have to index the whole market. Bad news, 30 is still a lot. It feels like it's work. If you do it on your own, it's work. The good news is you absolutely should break that 30 up over time, over market cycles, over several years. So all of a sudden, 30 investments breaks down to like 6 investments a year. People on Play Money, fun fact, because I told you I went on that data bender with Claude over the weekend. The repeat investor, sort of the pacing on Play Money, the average pacing of our repeat investors is about 6 or 7 investments a year. That's sort of a good natural pace for folks too, I think.
Okay.
That's what portfolio construction, game changer. I could now angel invest because I can't screw up if I do enough of these things.
Okay. So a few things there I want to recap a little
Did
bit.
I just talk too long in a row? I got so excited. I did it again.
It's perfect. What you gave there is a very important summary as far as some of the information. And one mental note, we need to get Abe on the show. He can maybe add a little bit of standard. No?
He's a pretty down low guy. He's really hard to find. You can't find him on social media. You can't. No, he's quiet.
Is he real?
He is absolutely real. I did a Zoom call with him.
Okay. All
He had a
right.
young baby in the background. Like, he's real.
Okay. So he's real. Check. 2, I want to dig in there. So everyone right now calls himself an expert in something, and quite often it's regurgitating a whole bunch of everyone else's information. Sometimes it's earned. But if I'm hearing you correctly, you're saying that you technically can't be an expert angel investor unless you're writing 30 plus checks. Is that going too far? Do you think the only metric that you can really bank on and double down is that 30 to 50 range of investments over a period of time to get a multiple that is healthy?
Ooh, that's a spicy question.
I know.
Well, let's remind everyone, like, we're talking about early stage startups, pre-seed, seed stage. This is before Series A. After Series A, they have more signal and you can cull a bit there. But before Series A, you're not dealing with a lot of signal. I'm gonna go. You know what? I'm going to go with the math on this one. The math says. And so particularly, and I think the math is particularly good to hold on to if you're an angel and you're not doing this professionally. Every professional fund manager has to sell that they can pick better or support their founders better because they're really hands-on. They have to say that they can tip the scales, and they all sell that when they try to get you to invest in their fund. And I am sure many do. However, what you've seen also is that these emerging fund managers, these new funds that invest in the early stage stuff, and they're, smaller funds, earlier stage, their strategies have started to change too. They're now starting to spread those small funds over 20 to 30 bets. That's a big difference than where we were 5 years ago, which is like, I'm going to make 8 bets and they're going to be the best. So people might use the term spray and pray on the surface. Those new funds, the fund strategy is like, nope, we need a diversified portfolio. Maybe we double down on some later, but they're even the smartest fund managers now at that early stage are making more bets. Is it
the equivalent almost of a power law on a VC side? They're playing the numbers game, right? Like, they know they need to make a range of bets and that as a return on their own portfolio to please the LPs. Is it a version of that in the angel side?
I mean, we're all trying to hit, like, the power law is a thing that exists in nature. There's some things that just outperform and they bias the average that way. It's a thing. By that nature, there's fewer of them. And in the earliest stages where there's so many things that could go right and wrong that are unpredictable, you need enough bets to hopefully grab some of those power law winners. So then it's just become a statistics and probability problem. Like when I teach Angel 101, I show a donut diagram of outcomes of the 2,500 companies, 500 startups invested in. And you see it right away, right? This percent fail, this percent break even, this percent have a pretty good return, and this tiny little sliver goes through the moon. Maybe you're magic, but it's actually at that early stage, it's luck. Are you going to get the go through the moon one or not? Which is why you see the ones that go through the moon. Like Airbnb is a classic one. Airbnb goes through the moon. Do you know how many super experienced professional top tier firms passed on Airbnb because it was a bunch of RISD designers selling cereal out of their apartment and like trying to sell people the ability to sleep on their couch? Like, come on, like some things are not knowable. And so it is big enough bets, particularly Angel.
I love the narrative where someone retroactively talks about their own experience because they were the first 10 checks into a company that happened to take off and they picked it ahead of anybody else. It's like, no, you got lucky like everybody else. Like the signal at that point is raw, as you say. Like you can look at founder,
Right.
look at experience. And what I heard from your story on AngelList and their analysis of so much data is that there's nothing that stands out as identifiable that helps you really double down on one company or one founder for growth. It's a multiplier effect of having more bets to have a higher chance of return.
Yep. It's funny. One of the other things that came out in this research is something Abe labeled infinite regret. And he was answering the question of, well, if you have the chance to double down on something that you bet on initially that's doing well, should you do it? And his answer for an angel was no, because it could be infinite regret because where that your amount of money is finite. Where that money could have gone could have been the next new thing that's actually going to be the one that rocket ships. You've already got a position in this first thing. If it rocket ships, it's going to rocket ship. All you're technically doing is diluting your returns because you're investing at a later stage. I talk about that as if you invest again at a later stage, is there an information asymmetry? And the thought there is in early stage investing, angels know just about as much as funds do because there's only a finite amount of information on that company. As that company moves through Series A and Series B, the professional investors have more information than any of us as everyday angels would get. Like that's just facts. So if a founder that's later stage is coming back to me as an angel looking for money, they better be able to give me a good strategic reason for that, why they're carving that out for angels or why they're doing me a favor, because there's more data to know and someone knows more than me and someone that knows more to me decided not to say yes. And that's why you're asking me. So I've got like a,
It's interesting. I have heard different points of view is that tapping the angels first. So it's like you invested early. I want to give you a chance here because we're going to rock it. Doing that as a courtesy rather than as a strategy. Like feels like that there's two things there that a founder could do.
Yep. And that's great. If you invested early and they give you a chance to double down on your investment and if you trust them and you feel close to the company, that's amazing. It's those random raises that are like, yeah, we're later stage and we have some room in our round to fill out and we're going to get someone to run the syndicate and, get some new angel money in there. That there's a differentiation there too. That later stage money, if you invest as an angel, it's going to be through an SPV. And usually those SPVs are black box. So it's not like the founder can even say, because I want this broad base of skills or bigger network on my cap table that I can tap into for strategic reasons. They're not even saying that in the later stages. In the early stages, what we're seeing is angel capital is becoming the most strategic form of capital because it comes with more connections, more expertise, and more amplification than, a single early stage fund manager could ever provide on their own. So early stage makes sense. Later stage, makes you question a little bit, but
Get it. I seriously do. And we'll tackle SPVs another day, another acronym we're thrown into the mix for folks to keep them dancing. But the other part that you touched on there too, which will cover again in a future episode is around the role that you play as an angel, which is really important too, about like a little bit of a hobby farm you may have. But to wrap up today, I want to play back to you a scenario here. So if you're an angel investor, and I'm putting this into numbers to try and help give some context for people that may be listening, say over 5 years you wanted to invest $150,000. So you're putting down $30,000 a year. You wrote 6 checks a year for $5,000, then you the $30,000 a year. Over those 5 years, you put down $150,000. Right now, that is by far the only tried and tested way with data behind it that gives you a higher chance of returning that investment. Is that accurate?
You know what? I'm going to go full on in a full-throated yes, because only a diversified portfolio changes startup investments from behaving like a lottery ticket to behaving like a predictable asset class. And that shouldn't be a stretch to say because the math shows it, but also this is how we invest in public markets. We know this already. This is not, oh my gosh, how could this be true? We know it innately. We invest in index funds. It's the same thing.
Perfect. What a great way to wrap up this episode on portfolio construction. We need to go. But Cheryl, thank you. I'm Andy Walsh from Startups Decoded. Cheryl Kellond, Play Money. You're listening to Angels Decoded. Angels Decoded, a weekly podcast for people learning the craft. Angel investing made easy. Subscribe, then decide. Angels Decoded, in cahoots with Play Money.